The third annual Global Private Equity Survey from Grant Thornton, entitled A Time of Challenge and Opportunity, provides a comprehensive analysis of trends, drivers and issues in the world of private equity. This year's report focuses on fundraising and deal flow, two key challenges, but also vital indicators of the industry's current dynamics and future success. Whilst fundraising remains the lifeblood of the industry, increasing regulation, disclosure demands, and the bargaining power and rigor of investors has led to firms needing to adapt to succeed in an increasingly competitive environment. This evolution has effectively created a new roadmap for a successful fundraise. As the fundamentals remain unchanged, firms must yield greater flexibility on fees and structure to maximize their chances of accessing capital, with co-investment rights increasingly in demand. Investor pressure has also impacted on the process, in particular by insisting that an earlier deployment of capital is achieved in pursuit of a more rapid distribution of generation of returns. In the light of increased pressure from LPs to see earlier realizations, 64% of respondents expect exit activity to increase, and 51% predict the use of dividend recapitalization activity to also increase. LP pressure is also causing GPs to consider alternative fund structures, and 56% of respondents expect to see an increase in their use. Overall sentiment for fundraising has improved over the last 12 months, with 29% of respondents reporting a positive environment, compared to just 11% last year. North America and Latin America show most enthusiasm, with both regions having over 40% of respondents stating it as very positive. However, 65% of respondents expect to be formally fundraising within the next 12 months. Notably, and perhaps predictably due to the volatility of currency and capital markets, India paints a very different picture, as all respondents stated the environment was either negative or very negative. One key challenge is the expected level of investor churn, with over 40% of respondents expecting at least half of the investors in their next fund to be new. This has been a factor in clouding the distinction between fundraising and investor relations. Firms see themselves almost permanently in fundraising mode, with a routine need to communicate successes. Whilst there is slowly improving confidence year on year that PE deal activity will increase, deal flow is highlighted globally as a particular challenge. It is most emphasized as an issue in Europe, but is also amongst the top 3 challenges for those in North America, Asia Pacific, the Middle East and Africa, and Latin America. The results show, however, that there is cause for optimism, with those expecting investment activity to rise over the next 12 months having risen from 44% to 54%. In Europe and North America, expectations of increased activity reach 58%. The reason for this paradox is perhaps that the improvement in the economic climate reported by many has yet to translate itself into improved deal multiples. As a result, PE firms compete with corporates, financial institutions and each other for the scarce supply of high-quality investment opportunities. There is a sign that competition from foreign and international private equity has fallen, which further supports the suggestion that investment is returning to home markets. Some of this optimism appears to be driven by debt markets appearing to open up. The proportion of respondents suggesting debt availability is very easy or easy has risen to 56% from 44%. This is especially evident in North America, where over 90% of respondents from this region state it is very easy to secure debt finance. Deal multiples are perhaps unsurprisingly forecast to remain flat over the next 12 months, albeit that there are also suggestions of growth in Europe, North America and Asia Pacific. The key sectors for activity continue to be healthcare, consumer, industrials and manufacturing, and business services, though the TMT sector is noted as increasingly productive. And across Europe and North America, driven by opportunities such as shale gas, there is a renewed optimism for activity in the energy sector. The private equity industry has been subject to numerous changes and increased regulation in the wake of public demand, media scrutiny, and government pressure. But there appears to be a sense that the industry has reacted appropriately, and now more stable foundations are in place. Many note that the image of the industry is now improving, and for those that abide by the new industry guidelines, the underlying optimism seeping through the results suggest the potential for a new phase of greater deal activity and the start of a new, exciting era for the private equity industry, with an increasing number forecasting improved returns. Grant Thornton is a truly global organisation with a presence in over 100 countries. We are ideally positioned to provide insight, support and advice to PEs and their portfolios in the pursuit and realisation of their growth strategies.